ZoomInfo appears to be a very solid company. I previously did a video on them when they were growing very quickly and said this was potentially even unrivaled. At the time, I warned investors, however, it was around $45 per share, saying, look, it would need to grow very fast and maintain high profit margins in order to deliver just a reasonable return over the next 5 years. And because the valuation was just so rich, it was baking in a lot of assumptions. Since then, the stock has lost more than 60% as valuation has contracted, and they've also posted weaker fundamentals. As you can see, their guidance for the year has come down. Previously in May, they were expecting close to $1.3 billion in revenue. Now it's closer to $1.2 billion in revenue. So seeing clearly weaker fundamentals. We'll talk about that in just a second. That said, they are still, as of the most recent quarter, growing around 16%, but this is down from 50% in the last few years. So they've seen a significant deceleration in their business. For those that aren't familiar, or if you don't want to watch my prior video on ZoomInfo, they're considered the gold standard for high quality data and insights for sourcing new businesses. So the way to think about it is that customers go to ZoomInfo for their proprietary data set that is considered the number one for lead intelligence or market intelligence or sales intelligence to help businesses drive new customers. And the reason why ZoomInfo has this proprietary data set is because they have artificial intelligence scouring the web, looking at public information, looking at billions of data points to create real-time leads of potential customers saying, hey, maybe this changed with a different company. Maybe this person's looking for a job. Maybe this, company just raised funds and they're in the space that you're looking to sell into. A lot of different insights have resulted in very attractive return on investment for many of their customers. And they have lots of different logos saying, look, Brand Live used them, and within 6 months we're generating $1 million from using ZoomInfo. Others were talking about a 10x return based on their ZoomInfo subscription, or they're talking about greater sales efficiency or a better pipeline in terms of new customers, or a better conversion rate of seeing someone in the pipeline to actually selling them, saying there's a lot of value here. But the question is it actually unrivaled? Previously they were growing 50-60% a year, and when you're growing 50-60% a year, it's easy to say, hey, it's unlikely that the market itself is growing that fast, so you're likely taking share. Since then, it's become very clear that there's a lot of different competitors out there that are absolutely trying to take share as well. For example, if you check out one software review website, it compares ZoomInfo with Apollo.io. They both have comparable amounts of reviews, around 6,000, 7,000 reviews. But Apollo.io across the board is rated higher, whether or not it meets requirements, ease of use, ease of setup, quality support. Support is actually one of the items where I've seen ZoomInfo get dinged. Oftentimes people saying, I wasn't happy with their support, or their billing practices, were a little too aggressive. So I'm seeing here it is, different competitors offering solutions that are comparable to ZoomInfo, maybe not the same proprietary data set, but generally, on par or equal in terms of reviews. So that is a bit concerning, especially when you see this Apollo.io also has lower pricing than ZoomInfo. So this could create real pressure for ZoomInfo in the future. And maybe is this part of the reason why that their sales growth has decelerated so significantly? Is this because of the competitive dynamics? This is what I think investors want to be thinking about or considering. It's also very difficult to get a clear picture on what exactly is going on, partly because a lot of these competitors are private, so you do not see what their sales growth is. Maybe ZoomInfo is growing, 15, 16%, and the competitors are growing, 10 to 15%. Though I would be surprised if that's the case. So it's difficult to get a sense on, well, wait a second, are these private competitors actually taking share? Are they growing in lockstep with ZoomInfo? That said, there clearly are a lot of different players in the space, though ZoomInfo does describe themselves as being a leader, and various different industry raters suggest that they are a leader in the different quadrants, saying, hey, this is the best, the high performer leader if you want to be spending money on getting leads for your business. And the challenge is, are they actually taking market share, or is it flat? Is it growing? I suspect with their recent guidance of around 12% that it's probably closer to flat versus taking market share. Now, management will say things like, hey, we're actually seeing better conversion rates and things like that. But it is a little concerning to see the deceleration in their business so significantly. And the fact is that a lot of their competitors are private, so you don't know exactly how fast they're growing. That said, they are tapping into a huge market, $100 billion plus TAM, total addressable market. So this could be several years of growth ahead of them. Now, and it's not only growth in front of them, they also already have a proven business model with significant free cash flow. And that is what I like to see. This has a lot of the things that I want to see with my investments, with a founder-led, significant insider ownership, lots of free cash flow. These are the developments I like with a business, strong growth. That said, they are facing real challenges, and management called out a few of these, in their most recent call, talking about how, they have about 35-40% of the revenue tied to the software vertical, and they're seeing their customers reducing spend because of a lower growth environment, and that they're focusing more on profitability. So this is less a conversation about ZoomInfo, more of a macro concern. And so far, everything that they're suggesting isn't really competitive related, it's macro related. They talk about budgetary pressures and the corresponding downward pressure on renewals. They think that maybe it'll get better in the future, but this is clearly a problem, that's resulting in them lowering their expectations for the year. Another example of a macro pressure, they're saying we saw continued elevated write-offs of our smaller customers. So while they're able to win large customers and able to have cross-selling and upselling for those large customers, they are also seeing a large chunk of their business, around 35-40% software, struggling. And that's partly because of a new environment where they need to prove profitability. So, there's pushback there. And then also their smallest cohort, they're saying they're not collecting. Now, that in my mind is another little bit of a red flag, because if you have all these different competitors, who are also lower priced, that's probably who the smaller companies are going to be trying first. So if you're noticing that you're having some problems with these smaller companies, that makes me wonder if, once again, that those private competitors are taking market share. It's, once again, tough to say just because, the information isn't transparent with the private companies. The question is, where does ZoomInfo go from here? First of all, in full disclosure, this is not financial advice. Also, at Unrivaled Investing, my goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies I can partner with and hold for years with the prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. So I would say, looking at ZoomInfo, it has many of the attributes that I'm looking for. The question is, what's the return profile? So I check in with AI Ticker Chat, which now covers the vast majority of US companies. I think everything above $300 million market cap. It suggests, using its AI Predict feature, and keep in mind, first month is free, it says that, hey, if their growth is actually, let's say, 10 to 18% in the years ahead, and their profit margins stay around 40%. That's a 40% adjusted figure. That includes adding stock-based compensation back. And it trades at, let's say, a premium valuation, partly because of the significant free cash flow. Then you could have maybe a couple 100% upside. Personally, this is a little bit more optimistic than my own take, but I agree with a lot of the key points that it's coming up with. One of my concerns, however, is I see that when I look at the company, that the CEO, Henry Shook, he's sold a lot of stock, and he's also sold down his own interest significantly in ZoomInfo. And he sold, well over $100 million worth of stock. I personally don't like to see that, especially from a relatively young CEO who's in his, I believe, late 30s, maybe early 40s. When I'm looking at this, he's got a long runway ahead of him. If he truly believes in ZoomInfo, he doesn't need that much liquidity. He could say, hey, I'm going for the ride. It's sort of like Warren Buffett and Berkshire Hathaway. You never really see him have this huge cash out when he was in his 30s or 40s or 50s or 60s. It was really when he was much later, when he's like, oh yeah, it's all going to the Gates Foundation. That said, Buffett's sort of an odd cat relative to most CEOs. But it is, a key point for investors to consider, is that I don't like to see a lot of insider selling. It's not just him, it's across the whole management team selling millions and millions of dollars of stock. That said, flip side is that ZoomInfo is still generating hundreds of millions in free cash flow. This year alone might generate over 400 million in free cash flow. And for a company around a $7 billion market cap, 400 million in free cash flow is very intriguing. I mean, you're effectively saying, hey, you have this growing enterprise. Maybe it doesn't grow as quickly as it does, did in the past, that 50-60% growth rate. Maybe it only grows, 10% on a diluted per share basis going forward. And keep in mind that 400 million includes a lot of stock-based compensation. So it's sort of, it's a muddy picture, but still $7 billion market cap versus 400 million in free cash flow. You're not talking about a crazy expensive valuation. So this is definitely more in the realm of a valuation where I would find interesting. And when I first did ZoomInfo and it was $45 a share, I was like, too hard for me because the valuation is so rich. You just have to bake in such lofty assumptions in order to get an attractive return. Now you're starting to get to a situation where, that's real free cash flow. That's a real free cash flow yield that you could get as a shareholder, and management's starting to buy back more shares, and that's offsetting their significant stock-based compensation. But it is interesting to see, based on my own assumptions, assuming around 8 to 12% per share growth in the years ahead. So this is, factoring in the stock-based compensation along with the underlying business, fundamental growth, and assuming, let's say, a 15 to 20 times multiple. Maybe that's too conservative, but assuming a 15 to 20 times multiple, keeping these optimized margins, to sort of get to a free cash flow figure that's relevant of around $400 million plus, I am getting to a situation that is a little bit more conservative than what I had called out a minute ago with AI ticker chat, where I'm effectively saying, maybe it's, 50 to 100% plus upside over the next 5 years. So, as I look at ZoomInfo, I certainly think it's much better risk reward than when it was at $45 a share. Clearly much more interesting. That's it for me. It's not quite at the price where I would say, hey, I think I need to pull the trigger on this. I think it's worth reviewing more, doing more work on it, following up on it when they report earnings, let's say later this month. So I think it's almost at that price where I'd pull the trigger. And maybe I'm being too conservative. You could say, Daniel, you're asking for too much. And that's possible. I also prefer setups where I could say, hey, even on a very low conservative framework, I could still make an attractive return. And I'm not quite there yet. So sometimes I miss things. Sometimes I say, it's not quite at that price where I could still pencil out, attractive return. Sometimes people go, oh, Daniel, look, you missed it. You clearly missed it because, this stock rebounded. Well, it just didn't hit that price where I felt really comfortable. And that's okay. I'm going to miss things in life. There's going to be a lot of pitches, to consider in the future. So I look at this and it's not quite the price where I'd say, what, this is worth, doing a super deep dive and making this, let's say, a 5-10% position. But it does have a lot of the attributes that I want to see. We're a recurring revenue base, lots of free cash flow, insider ownership, even though it's down significantly. So these are the things that I like to see. That said, another key component for investors to consider is the macro, which is that at the end of the day, management has just started warning investors about the macro impacting their business. If you see a recession, which you haven't seen, you've just seen a correction in the software space. If you see a recession, could this be the type of company that gets further downward pressure, where companies don't renew their subscriptions, or they just try out lower cost offerings, and then you start seeing more of a competitive threat play out? So that is my concern looking at this. I'm thinking this is currently around a high teens free cash flow multiple. In a recession, could this trade at a high single digit free cash flow multiple? And so that's sort of the thought process that's going through my head. Maybe it even gets to a low teens free cash flow multiple. So it's almost at that price where I'd go, okay, now I really want to do a deeper dive. And if I do a deeper dive, I'll do it in an exclusive, letter for my subscribers at unrivaledinvesting.com. But this is an overview that I hope is helpful for you. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thank you so much for watching Unrivaled Investing.